Adi Neville, Empty Wallet. In New York, in 1950, Frank McNamara turned a moment of embarrassment into a new kind of trust. He walked back into the restaurant with an idea you could hold in your hand, a card that would pay the merchant today and let the customer pay later. Not an endless loan. A charge that had to be cleared in full every month. Diners Club was born, and with it a shift in power. Money no longer needed to be present to be real. It only needed a trustworthy message that could move faster than a person. In the beginning, the system was small and physical. Clerks slid embossed plastic through heavy metal imprinters. Carbon slips piled up on counters and moved by truck to back offices where human hands reconciled every line. Det was en restpigget lot, but it's fast etablert crowd. Settlement took days. Fraud was clumsy. Even so, the habit was formed. People stopped counting notes and started signing their names. Banks saw something bigger than a travel card. They saw rails. Ik was in 1950 Balance, California. Tens of thousands of live cards dropped into mailboxes at once. Fraud exploded. Delinquencies spiked. Newspapers called it reckless. Yet, inside the chaos was the blueprint. Cards needed underwriting, shared rules, and a network that could check a balance in seconds, not days. Licensing followed. Bank Americard let other banks issue under one rulebook. Interbank created Master Charge to compete. By the mid-70s, the names changed, but the idea hardened. Bank Americard became Visa. Master Charge became MasterCard. To open, networks, thousands of issuers and acquirers, one language of payment that any trained terminal could speak. Technology turned that language into a nervous system. The magnetic stripe stored identity on plastic. Terminals asked mainframes for an approval in seconds. Visa's early systems cut clearing from days to overnight. Money began to move at machine speed. Once consumers felt that speed, they refused to go back. The card stopped being a piece of plastic and became an interfacer. Tiny contract any merchant could read and any bank could honor by morning. Law followed because scale without rules always ends in scandal. The Truth in Lending Act standardized disclosures so an annual percentage rate meant the same thing on every page. The Fair Credit Reporting Act gave citizens the right to see and challenge the files that scored them. The Fair Credit Billing Act created dispute rights and chargebacks. A quiet revolution that turned buyer beware into prove the charge. Trust deepened, not because companies said trust us, but because customers had recourse when things went wrong. Then one court case rewired the business model. In 1978, Marquette versus First of Omaha allowed a bank to export its home state-s interest rules nationwide. States like South Dakota and Delaware dropped interest caps to lure issuers. Major banks moved operations and scaled revolving credit legally and profitably. Interchange the fee a merchant pays on each sale-funded fraud systems, data, and rewards. Interest from carried balances funded the rest. Points and miles were not magic. They were the economics of a two-sided market rendered as perks you could feel. Hardware kept evolving. Chip cards brought EMV authentication and made cloning much harder. A liability shift pushed laggards to upgrade their terminals. Contactless tap to pay cut checkout, friction to a blink, and trained you to expect speed. Tokenization, pushed by wallets in the 2010s, hid your real number behind device-specific and merchant-specific tokens. A breached database could leak millions of tokens that would be useless outside their tiny cage. Online, where the card and the person never meet, the rulebook grew new armor. Address checks, CVV checks. 3D secure challenges for risky orders. Behind every approval sits a risk engine that studies device fingerprints, time of day, merchant patterns, and 100 other signals. You see approved. A swarm of models made the call. Look at the architecture, and you see to philosophies. Closed networks like American, Express and Discover issue and acquire under one brand. They own more of the journey and curate acceptance. Open networks like Visa and MasterCard do not lend or take deposits. They write and police the rulebook, while thousands of banks compete to issue cards and sign merchants. Closed feels curated. Open scales like a language. Both live or die on acceptance. If fees rise too far for merchants, acceptance fractures. If economics weaken too much for issuers, protections and rewards erode. The equilibrium is a living thing, pushed by regulation like the 2010 debit cap, and pulled by innovation like one-click checkout that hides the card behind a button. The card did more than move money. It retrained time. It separated the buy moment from the pay moment. Used well, that is power. You can buy flights today and pay on the 15th with 0 interest if you clear the balance. Used poorly, it is a trap. Minimum payments turn last month's groceries into a loan at 20%. Points can lure you into spending you would never defend in cash. Pre-authorization holds at gas pumps, and hotels quietly tie up a chunk of your available limit. Credit absorbs that friction better than debit, but many only learn the rule after a weekend trip goes sideways. Credit scoring made the training measurable. FICO in 1989 compressed your history into a number that set your limit and your price. Pay on time and keep your reported balances low, and the rails get cheaper. Miss payments and max out, and everything costs more, including the car you need to get to work. The card did not invent class, but it priced it monthly and mailed it to your house. For merchants, the card turned a cash register into a node on a global grid. Interchange became the rent to access the network. Processing fees became the lease for hardware, software, and risk tools. Chargebacks became the tax for mistakes and fraud. A small shop learned to close batches daily, to add address and CVV checks on higher tickets, and to send richer invoice data on business transactions for lower rates. Many paid a premium for flat-rate simplicity. The network did not argue. It just kept the lights on. Then came the wallets. Your primary account number faded into the background. Apple Pay and peers turned the real number into something you rarely type. Biometrics replaced signatures that nobody checked. Card on file became token on file. The payment became a yes whispered between devices more than a number sprayed across forms. At the same time, checkout splintered. Buy now, pay later. Offers tried to peel away slices of the transaction with installment plans that felt like discounts. The card kept running under the surface, less visible, more essential. So what did a forgotten wallet in 1950 really create? A protocol for trust. A rulebook that lets strangers become counterparties in milliseconds. A market that scaled without a central cashier. And a culture that can confuse convenience for wisdom if you do not set your own rules. The card made life smoother for the disciplined and more expensive for the distracted. It democratized acceptance and privatized attention. It gave you protections that cash never had disputes, zero liability. Tokenized it, made it effortless to drift into debt and call it normal. If you use this system, use it with intent. Treat the card as a payment tool, not a lifestyle loan. Turn on autopay in full so interest dies quietly. Note your statement close date. A small payment before the close can lower reported utilization and help your score. When you travel, decline dynamic currency conversion and pay in the local currency with a card that has no foreign transaction fee. Expect hotel and car holds and plan your available credit so a weekend does not strand you. Use virtual numbers for one-off online buys. Lock and unlock cards in the app like a light switch. Keep old, no-fee cards open to preserve account age and total limit. If a merchant surcharge beats your rewards, switch to debit or cash without ego. If a refund stalls, dispute within 60 days of the statement and bring screenshots. The rulebook is designed to work if you use it. If you run a small business, price the rails into your product and stop resenting them at the counter. Negotiate interchange plus instead of paying a hidden premium for a flat rate. Batch every day. Use address and CVV checks on shipped orders. Send Level 2 and Level 3 data on business invoices to lower fees. Treat compliance like insurance, not paperwork. The difference between cards are expensive and cards grow revenue is usually process, not fate. The future is already here. Tap is default. Tokens are everywhere. Your old card number will linger as an identifier. But what actually moves will be a token bound to a device, a merchant, and your face or thumb. Risk engines will get better. Regulators will keep nudging the balance between merchants, banks, and you. Through it all, one truth will not change. The network works best for people who write their own rules before it writes them for you, Adi Nabil. An empty wallet. A promise to return. Diners Club turned that promise into process. Visa turned that process into rails. Those rails turned into an economy that fits in your hand. The card did not just change money. It changed whose word counts at the moment that matters. Once, it was the shopkeepers. For a century, it has been the networks. If you want the benefits without the leash, set your rulebook now and follow it tighter than the terms and conditions you never read. And if you want the hidden court case that opened the credit floodgate sound, why your annual percentage rate still lives there, stay with this channel. The next episode shows how one legal sentence filled your mailbox with plastic.